Most investors think they're buying cash flow, but the ones who actually build wealth know the deal either works after taxes, depreciation, and the exit, or it never really worked at all. Today, we're unpacking why so many real estate investors overestimate cash flow, underestimate taxes, and how the gap shows up in your actual net worth over time. Stay with us, because my guest today is also giving away copies of his book, The Wealth Elevator, and I'll show you exactly how to get one before we wrap. If you've ever looked at a pro forma and thought, this looks too good to be true, don't skip around on this one. The nuance in the middle might save you years of bad deals.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Welcome back to the Tax Strategy Playbook. I'm your host, David Weiner, CEO of Cashflow Strategies, and a tax strategy guy who lives in the world of cost segregation, depreciation, and deal structure so you don't have to. On this show, we break down the real decisions behind building long-term wealth, not just what looks good on paper. Today, I'm thrilled to be joined by Lane Kawaoka, founder of the Wealth Elevator, to unpack why so many real estate deals look like winners up front, but tell a completely different story once you factor in taxes, risk, and the exit. Lane spent years helping investors move beyond chasing deals and start building real asset-based wealth through syndications, accredited investor strategies, and long-term thinking. And he's seen firsthand how easy it is to make mistake activity for progress. Let me say that again. And he's seen firsthand how easy it is to mistake activity for progress. Lane, welcome to the show. For listeners who might not be familiar with you, how do you describe exactly what you do today?
Well, I would say I kind of do it by experiencing it myself. I used to be an engineer a long time ago, built a portfolio of 11 rental properties by 2015, and then became an accredited investor, then kind of expanded into larger syndication deals. So I've kind of seen the beginning of wealth building and then in the middle, and then kind of see what happens when you kind of cross over the rainbow to some extent.
So what problem would you say are most of the investors you work with really trying to solve when they come to you?
Most of the folks I work with are later in the game, so ages 45, 60 years old. They've got a, greater than $1 million net worth. They might have done rental properties at one time, but they kind of understand that stage of the game where they're looking for $10,000 to $20,000 of passive income a month to sustain the rest of their years in retirement, that the little rental property ain't just going to cut it anymore, right? So, then again, you don't want to pile all your money into apartment buildings. That was my mistake, right? Like I had 90% of my net worth in 2021 and that stuff, and that didn't end well. Right. So kind of blending that with diversification. But how do you do that from an alternative investment perspective, right? Because all they teach in the beginning, or at least what I did when I was getting started, was buying little rental properties, right? But
And that's what a lot of our listeners have at this point. I think they need to know what comes in the future as well. When you look at your own portfolio now, what does it actually look like kind of in broad strokes?
I'm still a work in progress, right? I still was very heavy in commercial real estate, and we're an operator, right? We're the general partner of a lot of these large apartment buildings, and that's where our expertise is. So we're never going to get away from that entirely. But I've been, over the last several years, starting to diverse my portfolio into different asset classes that are not real estate, more buying businesses, private equity, in things that I sort of understand as a business owner. Oil and gas, right? Especially for the tax benefits there, especially for people unable to do real estate professional status. That's a big play, especially, in these uncertain times that we're in right now. I'm not going to say the W word, but, tends to perform well in those times. But, also, as I mentioned, a lot of my clients are, multiple $1 million net worths. There comes a time where you realize you've hit critical mass, or you have enough assets where heck, you could just put into T-bills and chill at that point, right? To see, you don't want to have a portfolio entirely of that. So how do you build this kind of more diversified pool?
And that's the idea behind the wealth elevator.
Right. So the idea is like you've got different stages of the wealth building game, different floors. So that in the book we kind of talk about and define these different floors because it's not just the same strategy all the way through. There's different paradigms.
Absolutely. So now that everybody has kind of a feel for who you are and how you invest, let's zoom out a little bit. Let's talk about the mental model behind your decisions, because that's where most people, I would think, quietly get it wrong. So when you look back at your own investing journey, what changed most in how you evaluate a deal?
I mean, in the beginning, right, when I was in the first floor of the wealth elevator, under $1 million net worth, buying little rental properties, it's in a way, it's very tactile. Like get a spreadsheet out, you start to, if something rents for 1100, you start breaking down all the expenses, taxes, insurance are the big one, and then your maintenance fee, your property management fee, and then your capex, which 10 to 20% depending on which rules of thumbs you're using, and that's how you underwrite deal, right? And you try to assume that some of these expenses are going to go up over time. You definitely don't assume that your rents are going to go up 5% every year, like all those other tools analysis out there. And you try to buy in the path of progress, right? To, in a way, get lucky with appreciation. But if not, you try to cash flow, right? So that's what you do on the first floor of the wealth elevator when you're buying your own little rental properties.
So looking at the wealth elevator, how does that help people see what they usually miss early on, like on that first floor of the elevator?
I think one mistake that people will make on the first floor of the wealth elevator, and I made this mistake too when I was working my engineering job. What you're trying to do is replace your income because maybe you don't like your job, right? And you want to get away from it. You want to quote unquote retire. So you have this idea that if I just replace my salary $5,000 to $10,000 a month, I would be able to now go part time or retire my spouse. So I think a lot of emphasis from an investor comes to cash flow initially. So there's two ways you make money. The cash flow way sounds more prudent from a perspective too, but there's also taking bigger risks where you don't get cash flow and like specifically like development deals where returns can be larger, but you don't have that. You have to delay gratification in a way. So I was initially when I was investing, my first 11 rental properties, I was focused a lot on just cash flow. And maybe I had with it, these 11 rentals, maybe a few $1,000s of passive cash flow every month after taxes, insurance, maintenance, the oopsie stuff that happens, right?
There's always oopsies.
But you start to realize like when your net worth grows, like $3,000 a month isn't much, right? I mean, it's kind of sounds like this is when you start to go up the paradigms.
So in your case, what was the aha moment that changed your approach?
Well, it came two ways, right? Like the thing that was pushing me was with 11 rental properties, I had maybe an eviction or two every single year, some kind of big catastrophe that happened every quarter, which was not a huge thing because I had professional property management doing this as I worked my engineering job, which was my main thing at the time. That was how I made money to get more down payments to buy more and more of these rental properties. But after a while, it got to be like a chore with dealing with these headaches that would happen pretty frequently, and all for what, $3,000 a month. Now, some people out there would be like, wow, I kill for $3,000 a month. And I was the same, right? But when your net worth goes over $1 million, that it just becomes more relative at that point. And what pulled me the other direction too at this point, this is around 2015 and 16, I started to interact with accredited investors, people with, multi-million-dollar net worth. And I started to learn the best practices that they did. And one of the things was legal liability, right? Like, I was lucky enough not to really get sued when I was owning these 11 rental properties on my own, but I didn't realize that I was exposed from, slips, trips, and falls. I had LLCs, but, you're the owner at the end of the day. The buck stops with you. And even if you wanted to, it may be a totally frivolous lawsuit, but at the end of the day, you have to defend yourself and get the truth out there. And that may cost 50, 100 grand that comes out of your pocket anyway. So what a lot of these people who are $1 million net worth or greater were doing, they're setting off their little rental properties, re-leveraging too at the same time. If you're paying down your properties, your return on equity goes way, way down. Some of my investors, they have paid off properties and on their rental properties and they're making like 2%. And I'm like, for all the headache and legal liability, you're better off in a T-bill from that perspective.
Heck,
That's kind of a no-brainer,
you're better off
you
in
know?
some savings accounts.
Exactly, exactly. But, I was just kind of at this point in my investing journey as just kind of a sponge, right? Like you take financial advice from people who are that next level up. And to me, net worth does not lie. I don't care how old you are. It's what your net worth is at the end of the day. And especially if you built it on your own. More. So what these guys were doing is they were moving into LP positions and getting diversification into more commercial assets, more institutional assets, higher quality assets than the little single family home mom and pop investor.
And I think that shift alone changes everything, because once your lens changes, the same deal reads completely differently. So let's talk about what separates a deal that just looks good from one that actually performs. And if this part alone is already making you rethink how you look at deals, hit follow or subscribe. This show is built for investors who care about what happens after the spreadsheet. So what's the biggest reason deals look great on paper but disappoint in real life?
Yeah, so let's talk a little bit more syndicated deals, right? When you get a deal, you get a pitch deck, a PDF, right? That it's all shiny. I mean, they're all nice these days. They're all AI generated anyway, right?
Yeah.
But what we like to do, I mean, our process, I'll just go through our process, right? Like we get the P&Ls and we get the rent rolls, right? Like I throw out that PDF all the time. Doesn't, most of it is market data, right? Like as an investor, you should kind of know what's in there, even if you don't have access to CoStar. We've got access to CoStar too, but so we can validate some of the numbers. But step number one, take in the P&Ls and rent rolls. That's why I like investing in apartments, because you can kind of see what the run rate from 2 years in the past was. And you should sort of maybe apply this to buying single family homes. But a lot of times you don't have that run rate because you're buying it from an owner occupied, or it wasn't run as a rental property. So
Right.
this is like kind of a nice advantage to apartment investing. But we load it up into our own analyzer, start to use our assumptions, and we kind of throw out the assumptions that the syndicator or operator uses because they're always rosy. And this is where we start to, level different deals from different sources and try to pick the best one, right? So that's kind of, I mean, we can go into more detail, of course, right? Reversion cap rate, rent increases per year. What are good assumptions and some of these big movers on the spreadsheet? But that's step one.
How do you personally, and how would you recommend somebody balance cash flow today versus long-term upside when you're looking at a deal?
I mean, this is the hard part, right? Because like operators and syndicators, they're gonna use certain numbers on the spreadsheet that may drastically increase the projected return to ridiculous numbers, right? Like, we may look at a deal and the operator says 120% return in 5 years, for example. But when we use the right assumptions, we decrease the reversion cap rate, for example, or, instead of assuming that the rents are going to go up 3% every year, we say 1.5%. That 120% may go down to 40% in 5 years. And at that point, it's like, no, why do this? That's not enough buffer there. But, once you get enough of these data points, you start to kind of understand when you normalize a lot of these deals, right? And take out the fictitious projections out there, what's kind of normal and customary. But for the most part, you've kind of got two types of deals out there. Ones that are more development based, where you're trying to double your money essentially, and with no cash flow. And of course, when I say double your money, it's plus or minus 50%, right,
Right.
on these things, right? But on the other side is more of these yield type of deals. So you're buying an existing property and there's not too much going on with it. You might do a little bit lipstick on a pig, but you'll eventually flip it and sell it, right? So there is a pop at the end. It used to be, sometimes it's maybe 1/2 to 1/3 of the total return you'll get is through cash flow, and maybe 2/3 of it is through the pop at the end. But these are, I mean, I'm speaking really in terms of generalities, right? So I'm just kind
Sure.
of describing two different polarizing types of deals within the real estate world of, say, Class B apartments, for
And
example.
there's a point at which an investor needs to decide, does he want cash flow today or does he want long-term upside and figure out which works better for him, I would assume.
Correct. And that's for one deal, right? But, a good investor should be in dozens and dozens and deals
And I
and
imagine they
diversified.
balance those out over the deals that they're in.
Right, right. And this is, I think, where like we always say, like, this is why we do retreats and community events where people can build relationships with each other. Because whenever you talk with each other, especially on the internet, it's all surface these days. And especially on the internet, you don't know who's legit and who's just a bot and who's a hidden review person. Uh, you always hear like, oh, what I'm trying to look for. Well, I'm looking for core plus this profile of one half coming through cash flows to balance, this. And it's like, yeah, but that's maybe 2% of your portfolio. What's the logic with the whole totality, right? Like you may be in things totally outside of real estate, private credit, T-bills, life insurance, right? Like that's just the tip of the iceberg for this type of stuff. And that always gets lost unless you have a good relationship. And that's why we always encourage people to come out to our live events, meet other real people,
And like you
get more
said, that's how
intimate.
you learned, right? Talk.
Yeah, I mean, but it starts there. I mean, that doesn't happen overnight, right? Even in the first year, you're not going to build enough rapport to get that information, right? But just to know that, you know, if I were to describe a perfect deal that I'm looking for to fit my my what my needs are, I guess, as an investor, none of my investments fit that perfectly, right? It's a scatter chart, a weighted average of something like that for that purpose.
And I think
Um,
people are really missing out when they focus too much on projected monthly returns. That's kind of short-sighted, I would assume.
that is, but that admittedly that where that comes from is a lot of people, especially when they're newer and they're more auditory. Whereas the more successful investors who are in dozens and dozens of deals, they're not floating out there on the internet, kind of flaunting how much money they have. That's stupid. You're a wealthy
Yeah.
person. You need to kind of hide yourself to some extent. But yeah, more in less experienced investors, they may be more auditory that, hey, this is what I'm trying to look for. But again, as you're mentioning just previously, like it's more holistic. It's like, you're looking for a piece in your portfolio. I guess maybe to use an analogy, like people like to do fantasy football, right? Like, I don't know who's the best, usually the best running. I don't really follow football these days, but you can't just pick all the best player, right? It's more about building a team of different positions. That's the way I would kind of think about building your portfolio. That said, I'm not a certified financial planner, so I'm not allowed to talk about this stuff. I don't know why I wouldn't,
This
but
is
you
all
can't,
opinion.
don't take investment advice from me. But what I've realized out there talking to wealthy people who built their wealth on their own is that their pie charts, their asset allocation mix is all different, totally different,
Sure,
right?
absolutely. And we've got listeners on the show who are brand new and first-time investors and have one short-term rental, all the way up to people who have large portfolios and some tax professionals who are listening just to kind of get some ideas and some insight into some tax strategies that maybe they're not too familiar with. But if somebody's just looking at the pro forma, is there one red flag that sticks out that you'd have them look for?
Yeah, I mean, I have a full e-course on my website for free on this, but like the top one is like reversion cap rate on a syndicated deal. Like if you were to pin it down, that is the one cell on the spreadsheet that can have you fudge the numbers the most. So you need to understand what the heck that number means. So what that is, it's a wild guess what the market is going to be in the future. So these commercial assets, they sell for a certain cap rate. Let's call it the prevailing cap rate or what these assets are selling for. So I don't know if this is entirely correct today's, but let's just for an example, if you're in Dallas buying Class B assets, so like 1980s assets in an okay area of Dallas, not a horrible area, but I think those assets today, they might be trading for 5.5. Let's just call it that, right? 5.5 cap
Okay.
rate. So you want to use typical underwriting standards is you want to increase the reversion cap rate to assume you're selling it into a softer market. I know that's a little counterintuitive, but the higher the cap rate it is in the market, the less money you get at the sale, basically.
And I think
So
that's something that people overlook.
yeah, right, right. And this is everybody, all the syndicators know it, so this is the easiest thing to fudge on their underwriting.
People don't
So,
actually fudge, do they?
uh, well, it's all a
They
marketing thing,
do.
right? Like you just if
It's
you're
marketing.
using this number and makes the numbers go show 300% return, that's easier to market. And it's not
Of
like you're
course.
lying or anything. You're using that type of assumption, right? It's going to come bite you in the end. So a sophisticated investor will normalize these types of deals so like if it was a 5.5 prevailing cap rate going in, they may use the assumption that it's going to be a 6% or 6.5% to even more conservative on the exit, right?
Probably smart. And that's where things start to break down because the same deal can look completely different once you factor in taxes, depreciation, and your exit. So let's talk a little bit about how you quietly work taxes into your decision making. And if this is changing how you're thinking about underwriting, send this episode to another investor friend who's still judging deals purely on surface level numbers. It might change how they look at their next acquisition. So how do taxes influence whether you move forward on a deal or you walk away?
Yeah, I mean, we've kind of have this is written in blood for us. I mean, we learned by experience. I mean, I bought a 300 unit in Houston. Then when we got into it was 150,000 a year for taxes, and I think now it's well over 400, maybe in 450 today.
Wow. Yeah.
So you're talking, was that 2, 3x? Insurance went up, doubled in a lot of these places. You know, we had some apartments in Gulf Park, Mississippi. We sold those because the taxes just like tripled on us on that one. But you know, this is why like all these line items, like you need to kind of underwrite them conservatively. You know, assuming that they're going up. You know, but you know that was in that time, so that was unprecedented, right? Probably happen again. Who knows,
That's
right?
that's that's pretty crazy.
But you know, like I would say, like comfortably, like you know, if you're buying an apartment today, things have kind of stabilized, right? So this is a lot less degree, but if you're looking at buying an apartment today and you looked at the trajectory of the taxes the last 5 years or so, and it's been going up, I think it may be reasonable to assume that the taxes may go up another 20% just to have that safety factor in there. I certainly wouldn't think that it's going to stay the same because nothing ever stays the same. I mean,
Well, and
we
it
live in a
depends on where you're at too, right?
right, right. So like there's certain areas where like there is a slack effect, right? Like these things, they don't just go up linearly. They kind of 10% here or even 20% here, right? Or, you know, 0% sometimes. So that's unfortunately how it is. And this is why you need to create enough value. And, you know, this is why we renovate the units to create that extra value in there, the forced appreciation to account for these things that you don't have control over, like taxes, insurance. These are uncontrollable expenses
But you
to
got to
some
have
extent.
a way to figure it in, even if
Yeah.
it's an estimation of how you figure it in. Where now, I'm in the world of cost segregation and bonus depreciation and kind of that sort of area. Where do tools like cost seg and depreciation actually fit into your decision process?
Yeah. So when you get into like an apartment deal, if it's a value add deal, right? I mean, there's always multiple strategies, multiple exit strategies, you know, but typically most times you try to guide to renovating most of the units and selling, which takes 3 to 5 years. And with that, you're kind of on that cusp. You and I were kind of talking about like, well, what is that general rule of thumb that people will say? When does it make sense to do a cost seg? I mean, I'll give my kind of my quick thing on cost segregations. You know, you're going to pay a sum of money. Sometimes it's relatively inexpensive. We will pay. I mean, we'll do the full blown cost seg on a large commercial asset. You know, 5-10 grand. It's substantial amount of money, right? But it normally will create a better benefit in terms of taxes and you know save today for
Especially
the
now after
owner.
the big beautiful bill.
Right, right. And it's somewhat tough to quantify, but generally speaking, like you shouldn't do anything unless it overwhelmingly makes a lot of sense, right? So if you're the general rule that I go off of is like, you know, say you have a $10 million building and you can't depreciate the land, but say on this $10 million building, I'm just making this up, like 4 million of it is the land value, and then the 6 million is the building improvement. What I've normally seen is about 1/3 of that coming back as depreciation year one if you're doing the cost seg. So $6 million improvement, $2 million of depreciation in that first year. I'm caveating this like a lot of factors, right? But just
Right.
discussion's sake. So with that 2 million, the deductions, assuming I'm the only investor, right? This is where the syndication deals, it kind of trickles down to the 100+ investors. $2 million of deductions at the 30 to 40% tax bracket, should be a tax savings of like at least $1 million. Well, no, a little under,
A
right?
little under, yeah.
A little under $2 million, right? Let's call it $250,000. $250,000 of tax savings today obviously pays for the cost seg study. But the thing
I would
about
hope so.
I would hope so, right? Like, this is, we're just dumb real estate investors here, right? So big numbers, but, makes a lot of sense to do it in that case,
I can tell you for sure that I've never charged $250,000 for a cost segregation study.
Yeah, yeah. But the calculation isn't as straightforward as that, right? Like at some
Right.
point you're going to sell this thing, and with real estate, unlike investing in oil and gas or opportunity zones, where those are the only two things that extinguishes the taxes. With real estate cost segregations, make no mistake, you're deferring it. And that can be a very powerful thing. If you're getting, what do we say, a tax savings of $500,000, and in 10 years that grows to 1 million, right? As opposed to paying the taxes, and then you pay the taxes in the end, like that's very powerful stuff there. Don't get me wrong. But there comes a point, if you were to do like the break-even analysis, and I think you and I kind of both agree, like the 3-year rule should be, if you're above that, generally makes sense to do the cost seg. If you're less than that, you might want to run the numbers more finely at that point. But we logic ourselves.
I think you need to model both ways anyway. There's always the 1031 exchange, which is going to defer it. There's like you say, oil and gas. There's opportunity zones where we've actually done episodes in the podcast on both of those, as well as the Delaware statutory trusts and the 721 upreach. There's all kinds of ways of affecting whatever your recapture might be later. But yeah, it's worth modeling it to see if it's going to be a good benefit to you. I would never recommend to somebody to do a cost segregation study if we ran a free estimate for them and we looked at it and said, it's probably not going to be a good idea. I'm willing to tell somebody that so that they don't make a mistake on that, as well as maybe the deal that they made.
Right.
So
right.
How do you think about exit planning when you know taxes are going to impact your real return?
I mean, this is unique to us, right? Like we're in the value add business. We make our money when you're renovating units, and individually on every unit, like, you're bumping the rents up, right? You're increasing the net operating income. And with commercial assets and residential single family homes kind of operate on the same thought process, but not as purely as commercial assets. If you increase the value of the property by increasing the rents, it gets divided by the prevailing cap rate, and that's how much money the thing is worth, right? So the name of the game is either increasing the income or in turn decreasing the expenses. We're typically not doing it. Our expenses are going up because we're offering better amenities. It's a better product, right? Which is why we typically see growth with expenses too. But at the end of the day, it's very simple. Income minus expenses equals profit. The more profit a building creates, the more value it goes up. So,
and I think you'd agree too, in general, you need to know what your exit strategy is before you go ahead and get in.
Right. But you don't ever know, like you're playing in a world of uncertainty and macroeconomic currents too.
It can change. Yeah.
It can change quite quickly. I mean, like we bought a couple of these like large plots of land, like 20 acres, and we were going to develop, right? We've developed multifamily apartments in the past. We got into those deals and interest rates skyrocketed, right? Plus 4%. And I think it more than tripled or quadrupled. I don't know exact multiple, but like it just didn't make sense to do the build portion. So for us, the smart thing to do was to just hold on to the land. And now we're land bankers at this point, just waiting for interest rates to subside. Very common situation. I mean, that's why you don't see the cranes in Seattle anymore, right? Like, I mean, just take one market. It doesn't make sense to build in this interest rate environment. Plus, another thing too is like the demand. The demand is a little soft these days because of overbuilding in the years prior too. But this is where you have to kind of look at the totality of, you go in with your plan, right? You know what your exit strategy is, but there needs to be a couple other exit strategies too, just in case things happen.
they say the only constant is change. So you got to have an idea where you want to go, but you also have to be flexible.
I mean, in that situation, the nice thing there is we don't really lose money, but we're kind of just stuck with this land, right? Which is kind of land is the closest thing in real estate to like a commodity, like gold, right? The value doesn't skyrocket until you start to add value to it, put buildings and people on it. But it kind of just stays in this innate state till better times, better market.
And I think the point of everything is you're not just buying property, you're engineering an outcome.
Right.
For somebody who's listening who maybe feels behind or completely overwhelmed, let's bring this down to a practical playbook that somebody can actually follow. And I'm going to encourage you to stick with us through the end, because I'm going to ask Lane what he'd do if he had to start over again today. And that answer alone is probably worth the entire listen to this. So if somebody feels like they're way behind, what advice would you give them if they want to build wealth, but they feel like, gosh, I'm way behind the 8 ball?
Yeah, I mean, it's always personal though, right? Like I kind of push back against that question. It depends on what floor of the wealth elevator you're at, what your net worth and what your income is.
Let's
If
say
you don't,
somebody who's fairly low on the wealth elevator, who realizes they should have started 20 years ago, but they really haven't, and they want to build some real wealth.
yeah, I mean, look, I don't cookie cutter things. I don't spin things for people. If you don't make less than 50 grand a year and you're unable to save 10 grand plus a year, I can't help you. You have either a budgeting problem, which is personal finance, or you have an income. Like you got to make a business or find a better job or go to. I'm not a fan of college, but apparently college kind of helps with that, right? Get your better pay. There are a lot of personal finance blogs, books out there, getting out of debt. But the people I work with, they make multiple six figures and they're able to at least save 10, 20 grand per year. And that's what I did on that first floor of the wealth elevator in my 20s and early 30s, bought rental properties, and just it's slow and steady, and it's just not a get rich quick scheme. But that's what got me over $1 million net worth.
But you never get there if you don't start, right?
You don't get there too if you don't have some traction, right? And specifically in money, traction is being able to save a positive amount. Even I think $500 a year is very low. I guess it's a start, right? It's gonna take freaking forever if you're gonna do that. But for practicality standpoint, like the people that I work with are saving at least $10,000 to $20,000 a year. That's the first goal, and I can't help you with that. That's just, I mean, I was lucky enough to have a good engineering job. I didn't spend my money on things I didn't make. But, I think you got to get yourself at least 25 miles per hour going, right? Like I
Well,
kind of help people go from
that's
40
good
to
advice.
100.
Looking back to where you were when you started to where you are now, if somebody's evaluating their first few real estate deals, like you did when you were an engineer, what's the one thing they should focus on the most?
They got to be a spreadsheet junkie. So I have a free analyzer on my website
I think that would help a
/turnkey,
lot.
and they just download that and just start playing with the numbers and start to build a scatter chart, right? Because I think in the beginning you don't know what's up, what's down, what's good, what's bad, right? But I think if anything, just start analyzing a particular property, and then you start to realize, oh, there's a kind of a trend, right? At this price point, this is how much rent I should get or net profit I should get by analyzing all these deals. You start to build the lay of the land, right? Kind of like how we're talking earlier, like, whoa, you got some deals that are all cash flow based, some that are more appreciation based. Nothing replaces you actually doing the work and analyzing these deals on your own, and then starting to kind of have a working knowledge of what are the normalities out there in terms of deals.
I think if you absolutely are shooting for cash flow at the beginning, you could be hurting yourself in the long run. There's got to be some kind of a balance between cash flow now and building wealth for the future. Am I
Yeah,
right?
and maybe I'll be a little pessimistic with this too. Like, look, when I started, I could buy properties at 60 grand that rented for 900. In
That's a little tougher.
2015, yeah, 2015, you're lucky to buy that same property that rented for $1,000 for 80, 90 grand. Now that damn thing is 140 G's. a year, and it's like negative cash flow. So I mean, look, I'm just stating the obvious here. And the reality is, like, unless you're buying this thing as dilapidated and a piece of junk, you're not going to cash flow on this thing if it's turnkey. So you have to somewhat get your hands dirty, which is a lot more risky. So be careful of these remote turnkey outfits out there. Or you have to jump into a general partner, a syndicated deal where a experienced general partner is kind of running the ship for you and also has skin in the game too. You have to go into more audacious business plans in this environment, which is not what people want to hear, but it's the reality.
Well, reality is important. So looking over your entire journey with this, and this is curious to me, how has your definition of financial freedom changed from when you started to now?
I mean, before it was like, let me replace my engineering job. And then it kind of switched to like, okay, as you start to up level and get around people on the second and third floor of the wealth elevator, right? Let me get to the 2 million, 4 million beyond. I define in my book, the third floor of the wealth elevator is like 4 to 5 million net worth, because at that point you can kind of get out of these more riskier assets such as real estate rentals and et cetera, where it's a lot of pain in the butt and a liability, and you can just T-bill and chill. And I think Mr. Wonderful said like true wealth is $5 million in T-bills, right? You get to that point. But what I do is, we take people kind of getting to that level or there already. They a lot of these people, they own like $1 million home and they're making like 20 grand on it. And even if the property had no expenses, they're only making 2% a year on. That's silly, right? Like it's absolutely silly to do that. But that
Unless you
conversion,
really like saying you're a real estate owner.
yeah, it's an ego thing. But a lot of it's just like they'll say things like, "Oh, I have a 3% mortgage." It's like, well, that was great in the beginning, right? But as you pay down this property, your return on equity is more important, right? So that's what you compare with your alternative, which that's why sometimes you compare it with T-bills or life insurance at 4 or 5%, and with as much pain in the butt, headaches, it's a way less. In a better return and less headache, or PITA, pain in the ass is what we call it. So, but you get the idea is that you have to kind of take on risks in the beginning, and to get that critical mass to then when you get to, if your number is 4 or 5 mil, right? And then this is where it's different for everybody. And this is why you get around other people that are kind of on the same trajectory, because, a couple with grown up kids that aren't financial liabilities anymore in their 60s may only need $2 million at 4% in T-bills or whatever. Whereas a family, like my family is still growing, we're going to need 5, 6 mil to get that critical mass.
And who knows where we're going. So who knows what you'll need in the future.
Yeah. All I know is you need more. So taxes are going up. So that's another reason why, kind of getting short on time, but that's another reason why like pay your taxes now might be the better way than to put it into a Roth, right? Again, I'm not giving any tax advice. I'm just telling you that what I kind of do. I kind of do a little bit both with my portfolio. You don't know. You got to hedge both ways. There is no right answer with this type of stuff.
Well, this has been great because it gives people a realistic way to move forward instead of just chasing the next shiny deal. Before we let you go, I want to make sure people know how to stay connected with you and how to get that free copy of your book. This has been tremendous. Thanks so much for taking the time to come on the Tax Strategy Playbook and show kind of how you really think about deals. If you'd like to know more about Lane and the Wealth Elevator, his contact information will be in the show notes at taxstrategyplaybook.com. And like I mentioned at the top, Lane's giving away copies of his book, The Wealth Elevator. I highly recommend you get a copy of it if you intend to move forward with your real estate investing and build true wealth. If you want a free copy, you could do one of two things. You can DM me the word book on LinkedIn, or you can reply to my email address in the show notes with book in the subject line. Either way, send me your name, email, and mailing address, and we'll get you the details on how to get your copy. Before we sign off, 3 quick things you can do if this episode has helped you. Number 1, share it with one investor who's relying a little bit too much on pro forma cash flow and not enough on after-tax reality and building long-term wealth. 2, subscribe to the Tax Strategy Playbook newsletter at taxstrategyplaybook.com. You'll get free resources, including my 2026 tax planning guide. That link is in the show notes as well. And make sure you're subscribed to the podcast on YouTube, Apple, or Spotify so you don't miss the next episode. One more time, Lane, thanks so much for joining me.
Yeah, thanks for having me, Dave.
I'm David Weiner, Mr. Cashflow, and this is the Tax Strategy Playbook. Thanks for listening. And if this episode changed how you think about cash flow, taxes, and real wealth, I'll see you on the next episode next Tuesday.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.